After independence, the 1940s to the 60s, India's stock market, like the nation itself, was just beginning its journey, a period that seemed relatively quiet. As India found its feet, the market grew. However, these early days were marked by a lack of strong regulation, a vulnerability that hinted at the challenges to come. The Indian stock market's journey from the post-independence era to the digital age has been one of significant growth and increasing sophistication, but also a continuous cat-and-mouse game between evolving fraudulent practices and the reactive strengthening of regulatory frameworks. Each major scam, while damaging, has served as a harsh lesson, reinforcing the undiminished need for investor vigilance and critical thinking in an ever-changing landscape.
Fast forward to the 70s and 80s, corporate ambition starts really picking up. And then there's this Reliance event in '82. That sounds significant.
It was, but maybe not in the way you'd first think. It wasn't a scam, more like a power play, a demonstration of market muscle.
Go on.
You had this group, a bear cartel, trying to short sell Reliance shares, basically betting the price would fall and trying to make it happen.
Dhirubhai Ambani
Didn't take it lying down. He rallied allies, the friends of Reliance, and they started buying aggressively, countering the short sellers.
So pushing the price back up.
Effectively, yes, they fought back. And
Ambani
even managed to get the market temporarily closed. It showed how a powerful entity could, controversially perhaps, step in to protect its interests and, arguably, its shareholders during a crisis. It revealed the kind of influence possible.
Interesting. A different kind of market dynamic. But then we get to the 90s, and that brings us squarely into the era of, well, major scams.
Harshad Mehta
That is the name everyone remembers.
Oh, absolutely. The Harshad Mehta scam in the early 90s was a watershed moment. He figured out how to exploit loopholes in the banking system.
Using fake bank receipts, right? What were those?
Essentially, they were IOUs between banks, meant to be backed by government securities for short-term liquidity needs. But Mehta managed to issue fake ones receipts not backed by any actual securities.
So just paper promises.
Basically. And he used the money raised through these fake receipts, huge amounts of money, to pump into the stock market.
Creating artificial demand.
Massive artificial demand. Stocks like ACC, their prices just went stratospheric. It created this illusion that you could get rich overnight.
Until the music stopped.
Precisely. The whole thing collapsed in 1992. The market crashed, and countless investors lost everything. It was devastating.
But something good came out of it, didn't it?
Yeah.
In terms of regulation.
Yes. That's the crucial takeaway. The sheer scale of the scam forced a reckoning. SEBI, the Securities and Exchange Board of India, was given much more power. It really kickstarted the move towards greater transparency, electronic trading, and stronger oversight to prevent that kind of manipulation.
So, a painful lesson, but one that led to necessary changes.
Definitely.
Then the 2000s arrived, and we had another big name.
Ketan Parekh
Different methods.
Somewhat different tactics, yes. Parekh favored things like circular trading.
What's that?
It's where a group of traders basically buy and sell the same shares amongst themselves over and over. It creates fake volume, makes the stock look heavily traded, and pushes the price up artificially.
Okay, so manipulating perception.
Exactly. And he heavily used borrowed funds, leverage, to inflate the prices of a specific group of stocks, nicknamed the K10.
And like Mehta, eventually.
Eventually, his network unraveled, the funding dried up, the artificial prices couldn't be sustained, and the bubble burst. Again, significant losses for investors caught in the fallout.
And then something slightly different in 2009, the Satyam scandal. This wasn't a broker, but a big, respected IT company.
That's what made Satyam so shocking. It wasn't market manipulation in the same way, but outright corporate fraud.
Brahmalinga Raju
The chairman confessed to inflating profits and cooking the books for years.
Inside a company everyone thought was blue chip.
Yes, a respected name, seemingly successful. The stock price collapsed when the news broke. It was a stark reminder that fraud can hide behind a veneer of respectability. Really hammered home the importance of, proper corporate governance and trustworthy audits.
A different kind of betrayal of trust. Moving into the 2010s, the manipulation seemed to spread, even into commodities. NSEL in 2013.
Right, the National Spot Exchange Limited. That scam involved selling commodity contracts promising high returns, but many of the underlying commodities didn't actually exist.
So investors were buying into thin air.
Pretty much. The contracts were fraudulent. When it collapsed, the money was gone. It highlighted that regulatory oversight needed to be strong across all types of markets, not just equities.
And more recently, 2019, the Karvy stock broking issue. What happened there?
Karvy was a different kind of breach. They were accused of misusing client security shares held in investors' accounts. They allegedly pledged those client shares without permission to raise loans for Karvy's own business interests, a fundamental betrayal of the broker-client relationship. It really underscored the importance of safeguarding client assets.
Okay, so that brings us pretty much up to date into the digital age of the 2020s. Investing now seems so easy, just apps on your phone.
It is much more accessible, which is largely a good thing, democratization of investing. But the flip side is that new threats have emerged alongside that convenience.
Like what? Cyber scams.
Exactly. Fake trading apps that look real but just steal your money. Phishing attacks trying to get your login details. Schemes promising impossibly high, guaranteed returns spread through social media or messaging apps.
And people are falling for these.
Unfortunately, yes. Billions are lost globally every year to these kinds of scams. The speed and anonymity of the internet create new challenges.
So regulators are playing catch-up again.
They're definitely working on it, trying to adapt rules and surveillance, but the pace of technological change is rapid. It really puts more onus back on the individual investor.
Vigilance is key. More than ever, perhaps.
Absolutely. That skepticism, doing your own homework, not falling for get-rich-quick promises, those basics are crucial in this digital environment.
So wrapping this up, this quick journey through the Indian market's history, it's really a story of growth, but also one constantly punctuated by these crises, these instances of fraud and manipulation.
Yes, it's a dynamic narrative. Growth and greed, innovation and exploitation often intertwined.
But the key point seems to be that each crisis, while damaging, did ultimately serve as a learning opportunity.
I think so. Each major scam forced regulators and investors to adapt. It led to stronger rules, better technology, increased awareness. The system, while maybe not perfect, has become more resilient because of these experiences.
Which leads us to a final thought for you, the listener. We've seen the market evolve, and we've seen the methods of deceit evolve right alongside it. So thinking about today's complex market, what's the one fundamental principle of investigation, of due diligence, that you feel remains the most critical to hold on to? What's that core idea you need to keep front and center as you navigate both the opportunities and the very real risks out there? Something to definitely ponder.
A very important question indeed.
Thanks for joining us for this deep dive.